So we start with duration over direction, and these are topics that are covered in other programs that I teach, but I think it only fair, since it's part of our trading checklist, if you're not familiar with it, to at least go over these rules. But there's a lot more information as far as making and managing trades and volatility, etc. in other courses I teach. So rule number 1 was that 45 days to expiration rule, and that's because we choose duration over direction. We want to give ourselves time to be right, and 45 days is the perfect window for that. Now, we never trade when it's less than 30 days, and we prefer not to be above 60. But if it's one of those things where it's 61 or 29, we're always going to go with 61. But of course, we prefer to be as close to 45 days as possible. So here's just a sample off a trade page of some platform. And all we're looking at here is the option chain, September, October, December, etc. And you see here the numbers show you the days to expiration, 9, 37, 100. So with rule number 1 right here, trade as close to 45 days as possible, hopefully you realize that if we're going to make a trade, we're going to use this option chain right here at 37 days because it fits our rules. It's above 30, below 60, not mandatory, but it's there, and it's as close to 45 as we can get with these other numbers. So 37 in this case would be our option chain that we would use. But that's trading rule number 1. Always trade as close to 45 days as possible.